The world in 2022, intensifying political acrimony, the highest inflation in more than 30 years, COVID-19 still raging throughout the planet, and the stock market, it's not exactly predictable either. There wasn't even a 10% correction in 2021, yet market participants expressed the highest level of anxiety in years. What do you do when everywhere you turn, the corporate media is shouting market turmoil and encouraging fear? Where do you turn for honest answers and insights? Right here. CB3 Live. We exist to deliver accurate, sensible, and well-sourced educational insights on the world markets, global health updates, and the U.S. economic data that can and will affect your financial future. At CB3 Financial, we don't just manage your assets, we become one of them. Welcome to this month's CB3 Live. Good evening, everyone. Live from Nashville. It's Thursday, September 8th. I'm Charles Brown, Portfolio Manager with CB3 Financial. We're glad you're here with us tonight. There's a famous jazz song called September Song, and it's kind of a lament of what's coming up with the winter, meaning it's not a great, happy, upjoyous song. Well, that's kind of the way the market is in September. In fact, September is the only month during the trading year, 12 months, where returns have been negative since 1950. Not every year, of course, but on average, it's the only year that on average since 1950 has been negative. So we're going to talk about that. And yet the secular bull market continues, in my opinion. So let's strap on our seatbelts here and see what we've got to talk about. The monthly review, inflation, economic indicators, all the above. If you're new to the program, please click the little bell that gets you notified when I go live. Subscribe to the channel, please. Also follow me on Twitter, Facebook, and LinkedIn. I tweet every single day, sometimes more than once, especially now as we head into the autumn midterm elections. I'll probably be getting out there more often when things happen to move the market. And speaking of occasions when something major happens, just hours before I stopped assembling my program, the news came out that Queen Elizabeth has passed. 70 years she reigned as the monarch of Great Britain. Now, what's even more astounding to me, and again, you know that I love what I do and I plan to work probably until my final days. Just 48 hours before she passed away, Liz Truss met Queen Elizabeth and was sworn in by her to be the next prime minister. To give you a perspective on Queen Elizabeth's productivity, her first prime minister to swear in was Winston Churchill. Okay, how is that for astounding? So whether you're a fan of the British monarchy or not, you have to really admire her work ethic, that literally she was working 48 hours before her passing at age 96. That's how I want to go out, okay? So what does this mean for the world? We don't really know. There are factions around the world that are part of the United Kingdom that want the monarchy either dissolved or no longer want to recognize it. Scotland wants to secede from the United Kingdom. Who knows? Now King Charles, and he became King Charles the moment his mom passed away. He enters with the United Kingdom. I wonder if he's going to leave his tenure when he passes with just England. So there's a lot of uncertainty. There's political uncertainty. There's economic uncertainty. And this just adds to what will be a very, very interesting autumn in the world. And I'll be following it for you. So in the monthly review, I won't mention this again, but I did call the market bottom on June 27th. That was not the low. The low was June 17th. So I was 10 days later than Tom Bowley, one of my favorite market forecasters. But so far that is held. Now, why do I say that? Let's look at a quick chart here. The bars that you see, red and green, mostly red, represent what has happened this year. And it has been mostly down, as you can see. The first green bar is the final attempt for the market to go higher before hitting the low for the year, which was June 17th. That's the second little yellow square down there. But the bounce back off of that from June 17th to August 15th was strong, and it made a higher high, as you can see. Now, we have a higher low if the low from 3 days ago was to hold or is to hold. We had a very strong day yesterday. Today was extremely volatile, somewhat because of the news and somewhat because of many things that are going on in the economic world. But I'm still holding to, I believe the low is in, and I think that we will be hitting new highs in January. More supporting evidence for this. What are the two sectors that led us off that low from June 17th? Discretionary, which is XLY, and technology, which is XLK. As you know, there are 11 sectors in the S&P 500. These two are the most important, and they are the largest sectors in the S&P 500, but they are what we call the leading edge, the risk-on sectors, where when people are buying that, they are expecting good economic times. Interesting that the number 3 producer during this time is XLU, which is utilities, which is one of the most conservative sectors. So there is no clear screaming bull here. And of course, if there were, everybody would be on board. All right. But I still see enough data that I believe that June 17th low is good. You guys have seen this chart many times. I update it. I get an update from Tom Bowley. You can see if you lean in real close, that tiny little pullback up at the top of that. This is the last 100 years of the stock market. The long secular bear markets and the long secular bull markets are in blue. So the red are the bear, the blue are the bull. And you can see the bull secular markets last a lot longer. We are in one now, in my opinion. It started April 10th, 2013. Here's a chart that I haven't shown you before. So look at that last block there, which is the bear market from 2000 to 2009. I'm going to zoom in on that. People say, well, this all just feels a bear market's a bear market. That is not true. Look at what happened here when the market peaked, the tech wreck, if you've heard that phrase, in 2000. And then basically the market went nowhere, just oscillated for 13 years from 2000 till, as I said earlier, April 10th, 2013, and then it takes off. Look at the 3 little red blobs there. That's the 2018 tax scare or Iran-Contra scare, whatever you want to call it, the overseas issues that caused the market to rock in late 2018. In fact, the low of that year was Christmas Eve. The second red blob is the pandemic, and now we're in the third blob. Are we going to pull out of this? I think so. There's just no indication that a new secular bear market is starting. There's just nothing in there at all. So that's what it looks like. This is the data I'm using for those of you that are clients to make trading decisions on your behalf. Those of you that are just viewing, that's fine. We welcome you here. But this is what we study at CB3 Financial on your behalf. This is a breakout of what has happened since 2009. So you can see we've stayed in a very strong uptrend. You can see the green highlight there. That's the pullback that we have had since January 4th of this year. The market made a high literally the first trading day of the year and then dramatically pulled back to this center line, and it's now bouncing off of it. Obviously, if it were just going to be a perfect bounce and go to new highs, everybody would jump in on the long side, on the buy side. But it's never quite that clear. So what we do is study the indicators that I'm showing you and others to make a decision on when it's best to be fully invested and when it's best not to be fully invested. So far, we have remained fully invested, meaning 99% of your money is at work since 2016. In fact, since the night of the election on 2016. We have lightened and gotten more conservative in some programs during this time, but for the most part, we have stayed fully invested. Financial conditions, this is from Oxford Economics, still are favorable. So this is an indicator, a summary of the Federal Reserve, economic climate, inflation, all the components mixed together still show, but this is a favorable time and that the financial conditions are accommodative for economic growth. I think that's important. Yet, you've seen this chart. This is the second time I've shown you this because it's important. This year is an aberration. What are the 2 years way out there on the left-hand side? And what do those numbers mean on the graph? The number of days that have had more than a 1% move, and today was one of them. Now you say, well, the market only finished up like 0.75. That's not a 1% move. Yeah, but what you missed was it was down almost 75 basis points. So when you add that range together, so this is the daily range. We are in a volatile year that has really only been equaled in 2008. Look at all the other years here that are far, far less volatile. And I'm not surprised because we had this huge move, okay, off the pandemic low, March 23, 2000. And I was doing this program then. And the market just made a skyrocket shot. That's the year we had 63% in CG and 62.5%, I think, in SG. Okay? We still have some more to go here. We've got to get the VIX lower. We've got to get, and obviously, and I'll get to the political section and other influences on the market. It's great when the market's primary movement comes from earnings, but there's so much else influencing market behavior right now that it's just inevitable that this is going to be a very volatile year. As we get to the election, it's going to be even more so. History of the bear markets. You've seen this before. I just want, for those of you that haven't seen every show, there's a list here of the number of downturns in the market. Markets always come back, okay? There's no such thing as a permanent bear market nor a permanent bull market, but there are more bull market days than bear market days. Almost 2 out of 3 if you look at the stats back to 1950. So I'm just encouraging you in a difficult environment that we are going to pull out of this. This is really the essence of what makes the market move. This is earnings reports. Those of you that follow me know that I show this every single time, and we are at the very end of earnings reporting season. Only 4 companies left to report that are in the S&P 500. Right now, we're at 77% beating expectations. That's about the norm, okay? But remember, we are technically in a recession. We've had 2 consecutive quarters of negative GDP. Look at energy, 86% of the companies beating their expectation. Industrials, 83%. Real estate, 87%. Technology, 86%. Way above the average for the S&P 500. This is why I look at this data and I continue to keep us invested, because the market is saying we understand what is going on out there. We aren't that concerned because corporate profits are strong. This is the data that we use to make trading decisions, not watching CNBC. In addition to that, there's a remarkable chart here that shows, and I've never shown this chart before, the number of corporate profits surging in the second quarter relative to GDP. So you would expect corporate profits to rise and be strong in a strong economy with increasing GDP. We are in negative GDP. All right, we've had 2 consecutive quarters. So even in spite of that, corporations are showing strong data. I'll go back to this slide just to show you 77% beat their expectations. And in the highly important technology sector, 86% beat expectations. And that is super, super important. I'm going to pause here and take questions, see if I missed anything in the sidebar, get a sip of water. I guess because of the passing of the Queen, I've become a little philosophical tonight in this program. So I just have some interludes here as we get over the 25-second delay here on YouTube. Whoever does not regard what he has as most ample wealth is unhappy, though he may be master of the world. The paraphrase of this is, money can't buy you happiness. And this is someone that lived very early, in antiquity, just after the death of Christ. So a birth of Christ, 50 years, 135 AD. All right. So before I start on the world economy, any questions? What do we got from Dr. J? I'd agree. I'd like to work as long as I can too. I'm with you, dude. Some years ago, Bucky Herzog worked on Friday and died that weekend. So what Dr. J is referring to here is Bucky Herzog was our boss. Dr. J and I know each other for almost 40 years working in recording studios. And we together admired his work ethic, Bucky Herzog's, because he was at work all the time. He just was never going to retire, even if he was doing something simple there. And so it was an amazing thing. And I do remember, that he died within a few days of that last day. So thanks for that reminder, Doc. Appreciate that. So inflation. Hey, Mark, good to see you join us here. It is true that inflation is the single most important problem from small businesses. You can see the little red dot here on the chart. It just continues to rise. And in fact, it's just a skyrocketing, and for good reason. Okay. So let me catch this question again. We're on a delay. Before I continue here, Tom said, when you speak of new highs in January, are you saying all-time highs? So let me be specific, as we're talking about 2 Januaries. This January 2022 of this year, the last all-time high in the S&P 500, okay? In January 2023, I am expecting new lifetime highs. This coming January. I don't think it'll happen this year. I do believe that it can happen in January. Some of it depends on how the election turns out and many other things that are happening right now that have nothing to do with earnings, but still affect investor sentiment. Okay, hope that was clear. So last January, or this year's January, lifetime high. It's going to take a full year before we get back to lifetime highs. It could be longer, guys, but I expect to see it. So there's no signs of a recession. With no signs of recession, treasury yields are jumping. So you wouldn't invest in treasuries if you thought there was going to be huge, huge inflation. So the traders are saying, we're not concerned about inflation. I understand that business people are, but bonds, which are very sensitive to inflation because they're a fixed return. All right, you buy a bond, has 3% yield. If inflation is high, you're stuck with that 3% yield, at least if you're in stocks, which are volatile, but at least you have an opportunity to make more. If inflation is rising and you're in a fixed return of 3%, you're getting hurt, okay? And traders are not saying that they're concerned about inflation, which is why bond prices continue to rise. So the inflation measure is off the peak, but remains too high for the Fed to say that we're going to consider to pivot. I don't see any, and Jay Powell's been very clear just as recently as yesterday. The Fed is going to continue to raise rates. They have to. They just got way, way behind in this cycle. So even though the core price is coming down, you can see that. I still think there are going to be enough drivers to keep inflation high enough that the Fed will continue to raise this year. They will be raising in September. I don't see anything in 2023, but we'll see as we get closer to that. So is inflation past the peak? The data is suggesting that. The July headline number, I have it highlighted there in green. It is backing off just a little bit, okay? And that's a good thing. Core consumer price index is also backing off. What's the difference between headline inflation and core? The headline includes energy and food, and those are the most volatile aspects of inflation, okay? So the core number is reducing those, and that's why the number is lower on the chart, all right? So what are we seeing that's encouraging? Restaurant and airline demand picking up strongly. There's not enough revenue generated in this industry to really threaten inflation. But one piece that I thought was interesting is that used car prices are falling. You might remember on the show just a little while ago, meaning 3 or 4 months ago, used car prices, you could buy a car and then, turn around and sell it 4 months later. No depreciation, just because there was so much demand. There was nothing on the lots. That's not the case now. When I drive by the car dealership row, I think every city has one where there's just like a gazillion dealerships on one road. Ours happens to be Cool Springs here in Brentwood, Tennessee. There are plenty of cars out there to buy. And again, that's good. It may not be good for the dealership. I'm not concerned about them. I want to see inflation come down. Inflation comes down either when supply is increased or when demand is reduced, okay, or both. So why am I not concerned about a recession? So Google Trends, the number one search term, since, 2018 or 2020, I suppose, really, because, that was when the pandemic happened. People want to know, what about a recession? What about a recession? Is it going to affect me? Well, they're probably too late to be searching for this, because the probability of recession, we're probably already in one. It's not like it announces it. It's not like, up on a scoreboard somewhere that, hey, we're in a recession. All right. Still, even with all the pessimism, the probability indicator is just a little bit above 25%. I do not believe this will be a deep, long-lasting recession. Why? Because there's so much demand, and I'll get to this in the employment section. There's so much demand for workers. Has that pulled back a little bit from 4 or 5 months ago? It has. Is it a substantial pullback to the point where we could start seeing mass layoffs? Not anytime soon. Certainly not in this calendar year. I see no indication of that at all. Because the employment scenario, and as you know, this program airs on the second Thursday of the month, because the first Friday is when non-farm payrolls is issued. NFP, they call it, non-farm payrolls, and that's when the government announces just what the payroll report has been. So we saw a tick up. Look at the blue arrow, and you'll see that a positive development for the Fed. They're glad to see that more Americans re-entered the labor force last month. That's a good thing, all right? That little bump up there. And the labor force participation rate is continuing to increase. So the number of people, the percentage of people, the survey was 62%, 62.2% of Americans. The actual number was just a little bit higher at 62.4. That means more people in the American economy are seeking work. Either they're running out of benefits or they just want to get back and work, okay, rather than taking handouts. And that's also a good thing. Okay, U.S. job creation remains above pre-COVID levels. All right, non-farm payrolls month over month, this is a big number too. We continue to see non-farm payrolls be strong. All right, so the survey of 298,000, the actual number was 315,000. All right, so that again, that's an expectation revised to the upside. More positive data. The COVID impact, we haven't talked about COVID in a long time. I stopped doing the segment, and the only reason I'm showing you this is because I'm showing you how each of these segments of society were affected in the workforce. The data to the far left is the world, and then we have from America, low income, low middle income, upper middle income, and high income. Those are relative terms. We don't really have a dollar bandwidth on that. But most of the damage, or most of the people that lost jobs, were the lower middle income of America. Upper middle income still down 11%, and even high income. But we are almost back to pre-COVID levels as far as actual salaries. Okay, and I expect this to continue. Obviously, if it continues at a real strong level, then that's going to continue to exacerbate the inflation problem. But in general, we do want to see recovery. We want to see people working. Therefore, the labor force participation rate increasing is a positive number for us. So there are still 2 job openings for every unemployed worker in the U.S. That's why this chart is just peaked at the top here. You can go back probably to the 1990s before you see anything even close to this. Those of you that know what I joke about this, this is not from Fred, as in Fred Flintstone. This is the Federal Reserve Economic Data Database, and these are important data points because the Federal Reserve supposedly is gathering data from their 12 different branches and then submitting that, and then the Daily Shot, which is one of my great sources here, assimilates that. But that we are seeing so many openings and not enough people to fill them, it's just virtually impossible to have a serious recession in that kind of environment. Never happened in my lifetime. Politics is important because it leads to policy. Policy affects the portfolio, and our portfolio affects our personal lives. The biggest story right now, as you well know, is the battle between the former 2020 candidates and the 2024 candidates for president. I fully expect Donald Trump will run again, and I expect Joe Biden will run again. And here's Merrick Garland saying no one is above the law. We don't know what happened at Mar-a-Lago. We really don't know what was discovered. I do believe that between now and November 8th, Joe Biden wants to see Donald Trump indicted. I also know that there are plenty of people on the other side that want to see the whole FBI seize and searcher thrown out. This is a distraction to the market. It riles people up. And I can give you an example here on the next page. Never done this before either, but I got this story and I think it's interesting. I know it's tiny. I'm going to read it to you. So 1 in 2 Ukrainians knew someone who lost a family member or was killed by the current Russian invasion. So that's half. That's half of all Ukrainians knew someone who was killed by the current Russian invasion, according to the Wall Street Journal. Half the country has now been irrevocably affected by this ongoing war. In addition to having a family member killed by the Russians, there are plenty of good reasons for Ukrainians to dislike Russians: displacement, constant bombings, and economic devastation. So therefore, it shouldn't surprise you that they don't like each other. The poll shows, this is from the Wall Street Journal, that 76% of Ukrainians have an unfavorable opinion of Russians. I think that's amazingly small, low number. Now, this person who wrote this article says that seems about right. I think it's low. But what really shocked me was how these numbers compared to politics in the U.S. When Democrats were asked, again, Wall Street Journal, what were their opinions of Republicans, nearly 87% are unfavorable towards their fellow American Republicans. So to put this another way, and that's why I put this in red, if someone was attacking your country, killed someone you knew, and you had to move and leave your country, your opinion of them would be more favorable by 11 percentage points than if once every 2 years they chose to vote differently than you do. Did you follow that? This is where we are in America right now, and it really has to change. I think it changes one person at a time. Everyone watching this program knows that I have strong policy opinions, and I respect those who have strong policy opinions that are different from mine. And we have to get back to that point, or this country is in for serious, serious trouble. Just my 2 cents in the political segment of the program. The only economic indicator that's really substantive this week is the University of Michigan Consumer Sentiment Index. That took a tiny tick up. So we've been going straight down since 2020, which of course is pandemic related. We had a little bump up at the end of 2020 and then straight down. But look at the little red dot that I put there. Consumer sentiment, and of course, why is this so important? Because 68% of the economy is driven by consumer spending. There are only 3 components to GDP. There is corporate spending, there's consumer spending, and there's government spending. In my opinion, the least amount of government spending possible, the better. I would love to see corporations spending more, and I would love to see consumer spending a little bit less. Frankly, I'd like to see more, infrastructure development, et cetera, that companies can do to expand on factories, et cetera, to be able to produce more widgets. But nonetheless, consumer sentiment, they're the ones that are buying all the products that Apple and, Samsung and all these people, make and sell. So when you see that tick up, that's a positive. So I wanted to bring that to your attention. The Fed is in the news. They're always in the news, but probably now more than ever. So Do you remember the secular bear market from 2000s? Excuse me. The dot-com bubble burst in the very early 2000s. We talked about that earlier. That was the 13-year secular bear market that I showed you pretty early in the program, okay? And as we recovered, the Fed went on a rate hiking rampage. Why? Because as we recovered from that, inflation got higher. So the Fed raised rates at 17 consecutive meetings. The first of those was in June 2004, and they didn't hit the brakes until June 2006 after their 17th rate hike. So what happened with 2 years of rate hikes? What happened in the market? Okay, so I know you can't read this. It's okay. Here's what you need to know. Follow the line that's moving along. That's the stock market, okay? It's generally going up, correct? All these little red emblems you see with the little lines are pointing to places and dates on the calendar when the Fed raised rates. So with 17 rate increases from the Federal Reserve, you would think, based on what you're hearing in the media today, that we are going straight down. Is that what you see on the chart? This is why I try to present data to you that is rational and not exuberant, okay? This is what happened. Could it be different this time? It could. It is not likely. If this stock market can survive from 2004 to 2006, 17 rate increases, and still move up, I think that bodes well for what we're going through right now. You can look here and see what happened in 2000. Let me see, we get the years right on this. So 2001, 2, and 3. So we had a move up here, had a short-term bottom. This is 1962. It's so small sometimes I can't see it. But I'm trying to show you different time frames, okay? So the Fed funds rate peaked at 4.5. You can see the little red box there. And then the market sells off when the Fed funds rate hits 6.0, but then it turns back up. So what's the takeaway from these last two slides? Go back to when I show you corporate profits. That is ultimately what drives the market. The second factor in what drives the market is Fed rate policy, and that's why I'm spending so much time on it right now. The point of this is that the Fed can just throw, grenades at the market. 17 of them. All right, let's go back to that slide. And the market keeps moving higher as long as corporate profits continue to be strong. Are they? Well, I just showed you the data. 77% of companies beating their estimates. In the technology sector, 86% are beating their estimates, okay? That's pretty good, strong data. So during this 1962 cyclical, not secular, cyclical bear market, the S&P lost 29% and fell 6.5 months. That's very comparable to what we're going through right now, literally 60 years later. Okay, literally 60 years later. It's lost 25%, dropped for 5.5 months to the June 17th low. If that proves to be the low for the year, I still think it will be. I think there are times to fear the Fed, but not when the Fed funds rate still sits at 2.5 to 2.5, 2.25 to 2.5. That will increase to 3 before the year's over. But that is still not anywhere close to as high as the chart that I just showed you. And the market still went up. That's the data. Turn off the corporate media. Look at the data. Watch this again. Okay, I'm trying to give you points so that when you finish this video or you come back to it, that you're going to be confident. Look, based on history, I don't see a need to freak out about my investment account because this is what has happened in history. Stocks tend to do just fine during rates hikes periods. Again, tiny data on the screen, but everything that you see in green are positive returns during a cycle. Yes, there were 3 red negative periods. One of them, 1977, 1983, and 1987. Okay, obviously big downturns, cyclical bear markets doing a secular bear market in each of those cases. All right, but the rest of them are green. The rest of them are green, even during periods of Fed hiking. So The positive here is interesting. First of all, let me stop and see if I've missed anything. I got Tom's question. Hey, Mark. Anybody? I'm going to grab another drink of water. You got a question, send it to me, and I'll get back to you. Okay, so the housing market has cooled. We all know that. All right. I, for one, am glad about that. Now, was I glad to see Zillow's estimate of my house drop 110,000? Probably not. But for the greater good, I'm taking one for the team because we're not going anywhere. We're staying here. It's better for buyers to have prices that are lower. And frankly, it cools inflation. Why? Because consumer spending is 2/3 of the economy. I just told you that, and you should know it from 2.5 years of watching these shows, right? And what's the biggest item that consumers buy? Homes. So if pricing is cooling, that is a built-in formula for reducing inflation pressure, okay? So the home affordability index is near a historic low. We're going back to 1988. So homes are not affordable, all right? And that's because of the incredible increase in prices. So now this is going to flip and go the other way. When I show you this, probably not next month, but November, I believe you'll see that going the other way. And what's one of the reasons for this? Because interest rates, we're at 6%. You know, if people say, you know, you should move, why don't you move and, I don't know, do something different from Nashville? Well, I've got a mortgage that's 2 5/8. You know, if you look down there at the end of 2020, beginning of 2021, that's where I got my mortgage. It just so happened to work out that way. 6%, I don't know. It's a tough time. And what does that do? It reduces the number of buyers. What does that do? It puts the brakes on home prices. What does that do? It cools inflation, okay? So U.S. home price expectations dropping both for the rental market, which is in red, and home price expectations, in fact, just kind of fell off the chart. Remember, stocks go up on a staircase and down in an elevator. Guess what? Other asset classes do the same thing. So our home prices, if you follow yours in Zillow or whatever you follow, you know, there's several sources out there, was stepping up, and then bam, dropped like $45,000 in 1 month in our case. And if you follow your estimate, you probably saw the same thing. Don't be alarmed by that. It's the same psychology applying to any asset, okay? The tulip crash of 1614. That's a great movie, by the way. If you want to see the first genuine market crash, it was the Dutch tulip market crash of 1614. I think I have that right. If somebody knows that date, you can Google it to me or send it here in the chat. So mortgage debt is growing. No surprise, because people are taking longer term mortgages. They're taking, you know, the best rates that they can find. Candidly, I have a 30. I'm at 2 5/8. I'll be glad to have the bank loan me 2 5/8. I put a nice down payment down, but the point is, if they're going to give me money at 2 5/8, and I know what the stock market can do for my accounts, that's why I decided to do that rather than another situation. But it is increasing mortgage debt and adjusted for inflation. So you see it actually going down based on the dollar amount, but adjusted for inflation, especially if you have a variable rate mortgage and this inflation stays with us for a while, it's going to get ugly, okay? And you'll be not surprised, I'm sure, to see that second home demand has almost plummeted. Now, it's been dropping since 21. This is a monthly chart if you look at the bottom. So, yeah, great time if you want to buy that second home, you know, out in the country, or if you live in the city. There are a lot of people willing to sell you a home right now. Plenty of inventory. So, and not only that, there's a lot of apartment buildings under construction in the U.S. So you'll see near high. Actually, we have to go back to, I don't know, 1970 to see the number of apartment buildings under construction. And that's because it's just not become affordable for many people to buy their own home. And I expect this trend to continue for some months too. The Dutch tulip markets remind me of crypto. I think that's probably accurate, Doc. I do. Thank you for mentioning that. Since you're there on the research, would you type in the chat box the year? I think it's 1614, but it's way back there. The first known market crash, Dutch tulip market crash. So Questions. A little shorter show tonight. So, getting out of summertime here, getting you guys back to your life. Any questions from you guys? While I am waiting for that, I told you I'd get a little philosophical. I'm going to do a new segment here. This is just, you realize someone, 70 years she was the monarch. 70 years. It's just amazing. And yet her life, in many ways, was just over in the snap of her fingers because time goes so quickly. These are some facts that I have found with some graphics here that I just think are pretty amazing. So did you know that your heart pumps approximately 2,000 gallons of blood through its chambers every single day? It beats more than 100,000 times a day to achieve this incredible feat. So if you plug in your birthday and calculate the number of days you've been alive, multiply that times 100,000. I mean, do you know of any equipment that can live that long? Not a car, not a computer, maybe a house, but this is a moving part. It's just an astounding data. 1634. Thank you, Doc. Yeah, I was off by 20 years. So that's close. So you take about 17,000 breaths a day on average, and you don't have to think about any of them, obviously. Yet if you want to stop breathing, you can if you voluntarily hold your breath. A typical pair of adult lungs can hold 6 liters of air. I think that's astounding. Every day, your body ensures you don't contract cancer thousands of times over. Now, let me get to the end of this before you say something. Cancer is formed when cells are altered in a way which reprograms their DNA, and it's estimated that tens of thousands of cells suffer cancer-causing lesions every day. Tens of thousands, but the body sends specific special enzymes scuttling around to inspect DNA strands for faults and fixes them before they turn into tumors. So obviously this process fails. If it didn't, cancer wouldn't be the second leading cause of death of various cancers that are out there. But thank you for that, Doc. Prince Charles, born on November 14th. How about that? Doc's birthday is November 15th, for those of you that want to wish him happy birthday in the November show when I do it. But I'm putting this on. I know it's not financial, but sometimes, especially when you have a momentous day like today, it's the end of an era and the beginning of a next era, and it just makes you want to reflect on what it means to be human. Yes, finances are important. Obviously, if I didn't think so, I wouldn't do this show. But when everything seems to be going against you, remember that the airplane takes off against the wind, not with it. That's actually from Henry Ford, not the Wright brothers. So the reason I mentioned that is I know this has been a difficult year. For those of you that are clients wondering if your accounts are ever going to come back, they are. Okay, we are doing our absolute best to mitigate losses and to position us for the return of the secular bull market. To that end, I am really, really excited to tell you that I will be interviewing the legendary Tom Basso. You don't know this guy, probably, but there is a famous book called Market Wizards, and then the new Market Wizards, and then yet more Market Wizards, and Market Wizards you haven't heard of. Jack Schwager, since 1991, I think, 30 years ago, more than 30 years ago, has been writing these books, and Tom Basso was in his second book. Tom's a money manager. He is a great human being, and he has a book called Panic Proof Investing, and we're going to talk about this. It's probably going to be pre-recorded. Tom's in Arizona, so we have a time zone difference. It might possibly be live, but I'm thinking it'll be pre-recorded. But what I'm soliciting right now is for you to send questions. So Tom will address psychological challenges it takes for the retail investor. Now, he's a professional money manager just like I am. But the psychology is what I'm really interested in, because unlike many of the traders in this book and the series of books, you get the picture of Mike Douglas there in Wall Street with the blood pressure monitor next to him. That's not Tom. In fact, Jack Schwager nicknamed Tom Mr. Serenity. So we're going to learn from Tom on how he approaches the market And there will be some technical things in there, which some of you will be interested in and others may not. But there will be dialogue that will be appealing to you, I think, as an individual investor on how to properly position yourself psychologically to withstand the ups and downs of trading and investing. So I'm really excited about that. If you have questions, please send them to me. We'll be doing this recording sometime in October, and I just can't tell you how excited I am to have Tom on the show. So that's it for tonight. This is the areas we covered. Now's your chance for questions if you've got any. Our next show will be Thursday, October 6th. And yes, that is the first Thursday of the month because I am traveling the week of October 12th. Okay? So, we'll be a little bit earlier, although technically it's still 4 weeks from now because there are 5 Thursdays in September. So, again, maybe Tom will be on that show that night. I don't know, but at the very least, you'll be hearing from Tom sometime in October. Send me your questions, please. cb3@cb3.com. My last piece of wisdom here is from Ralph Waldo Emerson. What lies behind you and what lies in front of you pales in comparison to what is inside of you. I try to remember that as a money manager and as a human being. And you realize when you see 70 years of a career and gone just like that, that what is inside of you, your character, your compassion, how you treat others. Yeah, money's important, but not as important as those things I just mentioned. So in summary for tonight, and I say this every time we end a program, for those of you that don't know, this is 2 Timothy 1 verses 7, okay? For we have not been given a spirit of fear, but a spirit of power, love, and a sound mind. And we need to use it. Indeed we do. Thanks for being here tonight. I always enjoy talking to you guys. If you've got questions, cb3@cb3.com or give me a call. Phone number's on the site. Feel free to review portions of this program. I know it gets techie. I know the graphs can be small, but I do my best to try to give you material that will keep you encouraged and be a successful investor by hanging in there for the long run. Being an educated investor, realizing that the news media is trying to sell eyeballs to the advertisers. And as an investor, that is not in your best interest. Okay? Mark, thank you. I appreciate that. Tom, thank you for your kind words. Guys, at CB3 Financial Group, we don't just manage your assets, we become one of them. Enjoy this early fall weather, and we'll see you next month.